Will the market go up or down? Should you lock in or float? Find out this and more with Master of the Markets, hosted by Barry Habib of MBS Highway. Brought to you by United Wholesale Mortgage.
Does your wholesale lender do this for you? Free customizable marketing materials, online loan tracking for your clients, returns your past clients to you, and complimentary client retention campaigns. Don't you think it's about time you found one that does? Partner with United Wholesale Mortgage and receive these benefits and more.
Hey, welcome to another edition of Master of the Markets. I'm Barry Habib from MBS Highway, and this is exclusively recorded for the Mortgage News Network. Well, it was a wild week. Unfortunately, one where mortgage bonds really took it on the chin, and interest rates did move quite a bit higher during the week. You know, there's a few things that took place. Got a jobs report that was stronger than expectations, now making it look as if the economy may be picking up a little bit of steam on the employment side, although we're not seeing it in certain areas like GDP and retail sales. So it's a very tentative situation. And here's the problem, is that you had wages increasing. The year-over-year amount of wage growth was 2.3%. That's the highest number in 6 years. And it's starting to feel like with a smaller pool of available workers now, that wages will have to start moving up, could cause something that would contribute to inflation. This wage pressure inflation could be another factor. We already talked about last week how it looks like inflation may be on the way up throughout the course of the year. So here's the dilemma. If the Fed says, wait a minute, we know certain aspects like GDP are really weak in the economy, we don't want to risk it and we don't want to hike rates, but inflation starts to move up, you know that the longer end of the market is going to take care of itself. We're already seeing that as interest rates rise. But the reason why we had this violent reaction in the marketplace is something that's called, we mentioned this in the past, convexity selling. Now, it's a big name. What does it mean? You have to picture yourself for a moment as a portfolio manager. And if you're a portfolio manager of a bond fund, you take people's investment and you have to tell them what your investment objective is, what type of bonds you're in. So if you're in bonds that have, let's just say, a maturity, a duration of 10 years or longer, that's going to be very different than if you have a bond fund where the maturities are 1 to 3 years. And I'll explain why. As you know, the longer you put your money away and tie it up for, the higher the rate of interest you're going to receive. So the longer the duration, if it's a 10-year fund as opposed to a 1-year fund, as far as maturity of those bonds, well, that longer-term bond fund is going to have a higher yield and pay you a higher rate of interest. The only thing is that it's going to be much more subject to market volatility. So, for example, if the maturity on bonds were just 1 year and interest rates were to move 1%, well, that's going to affect your bond fund by about 1% because the maturity in your bonds is very short. So the price of your bonds will only be affected by that 1%. But if the maturity is 10 years, well, then a 1% move in interest rate can affect the volatility or value of the fund by 10% because that means that if you're locked in at X rate and now the market rate moved up by 1%, you're missing out on 1% for the next 10 years. So it has a much greater level of volatility. So what we're seeing now is that with the maturity being, let's say, of a longer term bond fund, if you were the manager, 10 years, if, for example, interest rates declined, like we've seen in the past, if interest rates declined on mortgages, what do people do? They refinance. So as those refinances start picking up, what happens to the loans? They pay off earlier that are in pipeline because they turn over or pay off earlier. The average life or the average duration, it shrinks. So if you're expecting them to be there for 10 years, they might only be there for 3 or 4. Now, as a portfolio manager, how do you balance that off? Well, what you do is you put some 10-year treasuries in your fund because they don't roll over and pay off. People don't refinance those, so to speak. So they stay in your fund and they take that maturity and they bring it out for a longer period of time. Well, by you doing that, you're buying more 10-year treasuries, as are all the other bond fund managers. And that helps the price of 10-year treasuries, lowers interest rates even further, which actually causes people to refinance more. And it creates a cycle. It's called convexity buying. That's when you see interest rates improve, mortgage bond prices improve, interest rates get lower, and it seems to go on for quite a period of time. And we saw that towards the end of last year into the beginning of this year, where interest rates started to really decline. But there comes a point in time where the opposite starts to occur. So you start to see interest rates move up and up like we've seen over the past couple of months. And as that occurs, now those durations start to get longer in your fund. Why? Well, if you've got people with very low rate mortgages and they've got those on their home and the market rate starts to go up, 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 people are, of course, less inclined to refinance, less inclined to pay them off, even in some cases, less inclined to move if they're locked in at a lower rate, because if they move, not only do they potentially have the expense of a more expensive home, but now a more expensive home with a higher interest rate on another mortgage really compounds that decision in making them think twice in some cases. So what happens is the duration actually gets longer in your bond fund. So because it gets longer in your bond fund, now you don't need those 10-year treasuries. So to make room for those mortgages that are just going to stay on your books for a longer period of time, you actually offload those 10-year treasuries that you're sitting with and you sell them. This is called convexity selling. And as you start to sell off those 10-year treasuries, well, price on 10-year treasuries gets worse, it goes down, and the yield goes higher. So we've seen that 10-year treasury yield go up, 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 and that actually compounds the problem. Just like convexity buying spirals things and makes them go down, convexity selling spirals them in an upward way, and we see interest rates move up in very much a rapid fashion, like we're seeing right now. We saw this 2 years ago when convexity selling went ballistic. Here, it's starting to accelerate. Now, we do have quite a few things coming up over the next couple of weeks. We have another CPI inflation report. We have the Fed meeting this month. So there's a few things that may calm things down for the marketplace. But for right now, it appears that the market is just in this spiral. And we're hoping that there's some technical levels there that hold, that we can sustain ourselves. We have to watch this very closely and follow it. Fortunately, those of you that did take us up and have become MBS Highway members or even took us up on the free trial, you know we navigated through this perfectly, locking ahead of the jobs report, locking all throughout. In fact, since the April 27th look at the market, we have been bearish. And this whole convexity situation, if you become a member, you look back at the May 20th update. Back on May 20th, we were worried about convexity selling. We warned about it. We've been protecting ever since. So those of you watching who are members or who did take us up on the trial, you know you've benefited already. Hey, you've got to watch this market carefully. Sign up for a free trial, get on board, become a member, and protect your own pipeline, protect your customers, become a much more valuable resource, and seize the opportunities. We'll talk to you next week. Have a great one. Bye-bye.
Today's Master of the Markets was brought to you by United Wholesale Mortgage. Master of the Markets airs every Monday at 7 a.m. Eastern Time and can be viewed on MortgageNewsNetwork.com.
This is Mortgage News Network.